Welcome back to Equity Mates Investing, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a huge welcome. We have a massive episode today. My name is Bryce, and today we're answering the question, how to find a property poised for growth. To chat through it as always, I'm joined by my equity buddy, Ren. How are you?
Bryce, I'm good. I'm very excited for this episode. We always love talking property. It's a fascinating asset class that has captured generations of Australians and frustrated just as many.
Absolutely.
And there's plenty going on at the moment with house prices, with rental vacancy rates at all-time lows. And so it's worth talking about. And when we talk property, there's one man that we turn to.
That's it. We're bringing back Sam Gordon, who is the Director of Australian Property Scout. They're an investment buyers agency sourcing property right across Australia. And today we've brought Sam in to, as I said in the intro, help us answer the question around finding a suburb poised for growth. So whilst this is through the lens of an investment property for Sam, there's plenty in this episode for anyone out there who is looking to buy residential as well for their primary place of residence.
Yeah, I think if we take a step back, it's wherever you are on the property journey, whether you would like to buy a house at some point in the future, whether you're thinking about buying, like you're ready to buy as an owner-occupier, or if you've starting to think about property as an investment asset class, one thing that unites everyone is that you would like the property to go up in price.
Because that's what everyone says it does.
Yeah. And I think, whilst Sam is predominantly an investor, what we wanted to do was draw out those universal factors that we would all consider wherever we are in our investing journey. And so that's what we really want to unpack with him when he joins us shortly.
A massive thanks to Australian Property Scout for supporting this episode. If you'd like information on what Sam does, or you'd like to be connected to us, you can head to his website, australianpropertyscout.com.au, or just head to equitymates.com/contact and leave us a note and we can connect you with Sam. But without further ado, let's jump straight into it. Here is Sam Gordon. Well, Sam, welcome back to Equity Mates.
Boys, it's an absolute pleasure to be back in the room with you.
So since your last episode, we have had a number of questions around how does Sam actually find suburbs poised for growth? Because you always tease it in the episodes. It's the secret sauce that you're not willing to give away. And we understand that there's some things that you need to keep behind closed doors. But there are other things that just, I think it's sort of table stakes, and there are things that if you're looking for your own home, residential as well, that we can think about. So today's episode is all about how to find a suburb poised for growth. We want to talk about the market drivers and then break it down into macro and micro and kind of go through the checklist that you think about when looking for investment properties for your clients. So let's start at the top with market drivers broadly. Always changing, but fundamentals remain the same is kind of the note that you've started with here. So talk us through the first part here, market drivers.
When anyone's looking for an area to invest in, it's always important to note, probably firstly before anything else, is like what do they actually need in their portfolio. So a growth location or finding the best growth location is obviously what everyone wants to try to achieve, but it really comes down to budget and what are you trying to achieve out of it. So you may also need a strong yield out of it, so that may change your parameters of what you're chasing as well. You may need to purely chase cash flow, but you might want to do that in a growth location so you get the growth and rental growth as well. But you might need an area that you can target from a cash flow perspective as well. But if we're purely chasing growth and just trying to find obviously the highest performers, what we're looking for are the market drivers that are going to put a market under proper pressure. Again, there's multiple facets to this. Do you want something that's already running, which is easier to find because the pressures are typically already there, or do you want to try and beat the market and get in maybe either right at the start or 6-12 months out, so you can buy in at the bottom with the least competition possible and then ride a full market cycle. So again, it's very dependent on the individual and the investor and their strategy and what they're trying to achieve. But ultimately, the fundamentals are always the same when you're trying to find it. It just depends whether you're trying to get in early, or a market on the way through already.
So what are those fundamentals? And maybe if you just tell us at a high level and then we can delve into some of them as we go.
I mean, the biggest things, obviously, it comes down to supply versus demand, which we always talk about, right? So the biggest drivers are the things that are going to put a market under significant pressure. Those things are typically a shortage of housing with an increasing population, or just the population doing what it's doing, and investors potentially moving into an area, but not enough housing there to be able to absorb that amount of demand as well. So really, like the points I kind of, I've kind of got prepped up here that we're going to talk about are all the fundamentals that will put a market under proper pressure. And then it just depends on the market that you might be researching, or where you're looking at, or what you're looking for. It's really overlaying and almost getting, it's almost like a checkbox, like this location, how many of these boxes does it check? So some of them matter a little bit more than others, but the more of them that you check, the more likely that you are in a growth location.
So let's go through the macro fundamentals. I'll just kind of list them out so we are aware of what we're going to cover. And then to Ren's point, let's go through some of them. So the macro fundamentals are the cycle, the state influences on property, population growth, unemployment rates, infrastructure projects, economic vibrancy, land inventory, and build prices.
Yes.
So they're the big macro fundamentals that go into what drives the market or the suburb that you're looking at. So let's start with cycle.
Yep.
Talk us through it.
Cycle's a funny one because a lot of people try and dispel the idea of a cycle, but I am very pro understanding a cycle and making sure you're buying at the right point. So a lot of people will talk also about past growth, right? But past growth is definitely not an indicator of future growth. So if an area has had 12 to 15% or even 10 to 15% per annum average capital growth over the last 10 years, I'm very wary of an area like that because it's more than doubled in the last 10 years. So it's something you have to be, again, very, very careful of. And so when you're understanding the cycles that a market's in, really you're understanding it from an affordability perspective. How much room does it potentially have for growth? It really comes down to an affordability perspective of where it's at. And when it's had a huge run, a lot of the time it doesn't have that potential to continue to grow, because when you look at an affordability, and we've spoken before about median incomes to house price ratios, it's so important to understand this, because if you're buying in something that's at a very frothy point from that perspective, it doesn't really have the room to grow. So when we talk about cycles, we're typically talking about cities. States can sometimes be kind of, almost bundled into a cycle. But normally it's like a city or a region. Where is it at in a cycle? Is it nearing a peak? Is it past a peak? Is it bottoming? Is it just lifting up? It's very important to understand where they are. To get a really good snapshot of whether it's worth initially putting the time into researching it or not.
I think the classic example that you've spoken to us before was everyone thinks about Sydney just being an uninterrupted growth story, but really and correct me if I remember this wrong, but between 2003 and 2013, Sydney basically traded flat.
Yes.
And then the cycle really picked up from 2013 to just before COVID.
Yeah.
And so that's a classic example where that 10-year period, as you were getting into 2010, 2011, 2012, you could have looked at Sydney and said, it's been almost 10 years of nothing.
Yeah.
There's opportunity here.
And then you look at the other markets that doubled in that time frame. So Perth, Brisbane, Adelaide, Hobart, they all doubled from 2004 to 2007. So it's this period where Sydney flatlined for 10 years. You could have doubled your money in any of those capital cities or more. A lot of them actually did around about 120 to 150% as a city. So imagine sub-markets that actually outperformed that as well. That's why I was kind of saying it was almost like an anomaly, because doubled in 13 to 17, trailed off until COVID. Literally, it actually dropped off by about 10 to 20% depending on the location, and then obviously went through that COVID run. But obviously there's different pressures, and we are in a different environment right now that was brought on due to COVID. A lot of build companies going under, so not being able to build enough homes. Now we're in massive population growth, so we're in a bit of a different time. But even still, when you understand the affordability of a market in its cycle, that can really be a very, very early indicator of, do I even put the time into this? And a couple of these big ones from a macro perspective are designed to cancel areas out. And that's the whole point of when you're going through a checklist. It's almost like peeling back the onion, you know what I mean? You got heaps on the outside initially, you peel that layer off and you get rid of heaps of them because it's the biggest, right? And then again, you peel, and you keep peeling back these layers to eliminate areas. You're not trying to find areas, you're trying to eliminate areas in this, especially this early piece, where you're starting with over 15,000 suburbs.
And when you're looking for data on 15,000 suburbs, what's your data source to sort of get that? Is it just core logic, or is there... You're smiling. So I'm guessing you've got some proprietary data, but like for punters like Bryce and I, if we want to sort of see where different suburbs are in cycles.
I mean, CoreLogic definitely gives you like a very easy indicator. If you're just looking at like kind of average annual growth rates, even I think realestate.com will provide that sort of stuff. So there are free platforms that'll give you that sort of average annual data. But yeah, man, like in terms of like the proper data we use, we have 6 different sources that we pull from, plus proprietary stuff that we have internally as well. So there's a lot of like, and the 6 are paid, sources where we get that data from. That is one of those things, you can very easily sort of find that. You go looking for average annual growth rates just to give you an understanding of where should we just eliminate immediately.
Yeah.
So the second one is state influences on property.
Yeah.
So how does that affect what you look at?
It's a very big one. So again, it allows you to very easily eliminate states at a certain points in the cycle. So if you look at, say, an area like Victoria right now, they just went through a massive land tax reform. They went through a big landlord reform as well. So like, you don't really want to be a property investor in Victoria right now. And we're seeing a big exodus of people actually selling out. So I've got family that are actually real estate agents in Melbourne. I've got a lot of investors, clients, obviously, that live and based in Melbourne and previously had properties there as well. There's just been a huge exodus in the last like sort of 6 to 12 months. I don't see that changing anytime soon. They're not making it pro investor area. They're trying to kind of get that shift back to owner occs. It may bottom out sooner than a lot of other areas, which means in the next couple of years it could be worth looking at. But right now we're not at the bottom yet. We're kind of going through that downward sort of slide as people are exiting. And they're the sort of things, and they change all the time. So Queensland in 2019, it was 2022, I believe it was running really hard due to COVID. A lot of internal migration of people moving up from the southern states. I did it. So I moved up from Sydney and moved to Queensland, and there was this huge shift. And then they brought in the land tax reform. Again, they did it as well. It lasted, I think from memory, it was either 98 or 101 days or something like that. And I openly went and called that it was going to get overturned. I just didn't see how it was, because the housing crisis was so prominent in Queensland at the time. The whole idea of it was to stop investors. But what they did was they did a land tax grouping, right? So regardless of, you could own one property in Queensland and 20 properties in Sydney. They would take your rateable land value in Sydney and apply it to Queensland and tax you on the whole amount.
Oh, wow.
So there was a mass exodus, and it went dead flat for about 9 months because they were talking about it. They brought it in, heaps of people exited, and then they overturned it. But then heaps of people were still like it was just such an uncertain thing. So that's where these, they do have a really significant impact on the market. And that can even come into, land tax reforms, landlords, first homeowner grants, all that sort of thing as well, depending on where the market's at or what the prominent thing is, even in potentially an area. Grants and different things can drive massive booms on that front as well. Like the build crisis that we're in right now is because government's brought in a grant. It was only a small window, but it made so many people jump into land and start building. And then people were fixing pricing on contracts that were 12 months away from starting. And then by the time they got there, material and labor increased so much, builders couldn't do it profitably. And then so many of them went under. So all these sorts of things you just got to factor into the equation. Those state influences are massive, where it comes to the stamp duty, the land tax, or the landlord sort of stuff as well. You've got to be over it because you may think something looks good from some perspectives, but when you understand these things at a deeper level and how they'll actually impact a market. But again, when markets move in cycles, investing for long term's okay, it's good. From a cash flow perspective, I'm a believer in it. But when it comes to growth, I like to get in and out of markets. And I always look at a 3 to 5 year window. 5 years is kind of like riding a market to its sort of full peak. You hold over the long term, you got to weather all this stuff the whole way through. And if a market's down for 10 years, I just, from a growth perspective, I don't see the point of it. Look at velocity of money. I prefer to pull my money out and be somewhere else. And like that is Sydney example. You could have doubled your money in Sydney 2000, 2003, pulled out of that, doubled it again in any of those 4 capital cities I mentioned earlier. Got out of that, got into Sydney in 2012, and ridden it again. So, but I like to move my money around a bit more aggressively than just sitting it in something for, let it stagnate and let inflation eat out my profit.
So the third big factor is one that I think people probably intuitively understand, population growth. So is there any quirks to this, or it's just a supply and demand game?
When we're talking about sourcing locations, obviously population growth has become a big thing in the last, let's say, 12 to 18 months, right? Because borders were closed, reopened, Australia's getting smashed. We're also in a massive housing shortage. So like when you throw that in the mix as well, that's what's creating, and a lot of people understanding the population growth on that side. But if people are listening to this in 2 or 3 years and maybe the fundamentals have changed a little bit and maybe it isn't so crazy from an international perspective, population growth at a smaller level, so when we're talking maybe a city or a region, can be a massive influencer of demand. But why are people moving into that area? Why is there such strong population growth, or what's going to drive that super strong population growth? I like to look at it really closely from a more of a region perspective than a capital city, because it can be such a massive influencer.
Well, I think that probably is pretty closely tied to the next one, which is the biggest driver of population growth to certain areas is availability of jobs. And the fourth factor you have here is unemployment rates.
Yeah. And it also ties in really closely with the one that follows it again, being infrastructure projects. So the two of those are almost always very, very closely linked. When something has a lot of infrastructure projects in the pipeline, it will drive a lot of people into a region, sometimes trying to get ahead of those things, either being announced or knowing they're in the pipelines and being imminent, or some projects coming in, being approved, and then some other big ones coming in after it. Massive driver of population growth for one, which then in turn turns into super low unemployment rates, and also tightens up vacancies and everything, and really eats out stock right across the board. So those two are super, super important. When you've got really, really strong or really low unemployment figures, you've got a really, really strong local economy, which means there's more money flowing around. People are being able to ask for salary increases, wage increases. The incomes are lifting in an area as well, which allows people to pay more for both rent and sales price. And a lot of the time, it attracts people of a slightly higher demographic or persona as well. You're going to attract better people to an area if they're being paid more as well.
And then that all flows into the sixth, I guess, which is overall economic vibrancy of the areas that you're looking at, which I imagine, as you said, just kind of neatly sums up population growth, which leads to unemployment rates, infrastructure projects, and then the type of people that are attracted to these areas and the flow and effect that has to overall economic activity. Yeah,
definitely. And even like your main streets and stuff, something we always do before we go buy anywhere. We'll go drive and walk the main streets.
Mainies.
Yeah, 100%, man.
Nice.
So we've got two more macro factors, land inventory and build prices. Before we get to those, because they're somewhat related, I've always heard that schools are a big one, and like you can sometimes correlate improving schools and better school test scores with improving house prices.
Yeah.
Is that bunk, or is that...
I'll call, in your terms, bunk on that.
I was going to say something else, but
When a market's flatlining, if somewhere's like desirable from something like that as a perspective, let's say Sydney when it had its downturn and all the rest of it in 2003 to 2013, your areas that are more desirable from that perspective, yes, they will stay more desirable, right? But they're always going to trade at a premium from that perspective regardless. My honest belief is you actually will be able to get a better deal away from those areas that aren't in super high, like aren't in that typical like really high owner-occ demand areas. You'll actually be able to get a better deal outside of that because you're not competing with people that are like emotionally getting in there for a specific reason. So you can get a better deal. And I've researched this so many times. There are so many examples of your almost like, let's just call that a lower class area during a boom that's maybe like next to or a couple of suburbs away from that will actually almost always outperform those more desirable areas, because the more desirable areas, they hold at a higher level, they hold at a premium. But when the market runs, man, like people are just trying to get, okay, what can I get in that's still close to that? And so they'll still buy into those sorts of areas very nearby. Man, I've always seen it I look at the stuff that we bought in Brizzy and went through the boom, and the more salubrious areas that were actually highly desirable from an owner-occupier perspective did maybe, during the COVID boom, maybe like 50 to 60%, and some of our kind of more lower class sort of areas that weren't as desirable that we're going through gentrification did between 90 to 100% in the same time frame. So it's one of those things. I think we'll call the bunk on it from that side, because they will hold up better, especially in a downturn. But from a growth perspective, I don't believe they'll outperform.
So that leads to the final two macro factors: land inventory and build prices.
Yeah, so land inventory probably plays in a little bit to the point of Wagga. So 25,000 people, we're talking about something like probably 15,000 homes, 10 to 15,000 homes in the next 5 years. For a city the size of Wagga and how many building companies are going under, like it's an impossible sort of prognosis. You know what I mean? Like it takes too long to get these things approved. and then like the land approved, DA approved, and then obviously get it through, stamped by council, then actually get it developed, and then actually build the homes on them as well. So it's like the government saying they want to build $1.2 million homes. We're 1 year in and we're 90,000 homes short of the first year target. We're not going to hit it, you know what I mean? Like, so it's one of these things of understanding the land inventory coming through. It's really important to understand what stock will be coming on, and it works both ways. So when you can see that it's very, very tight and there isn't that much coming through, or you know it's a council that's really slow, if all these things are overlaying on each other and then land inventory is really low, or that process, like there's just not that much coming through from that perspective, you know it's going to be a delayed period before new homes, whether it's, you know, apartments, townhouses, or land to actually be built on comes through. And if we're going to have that lag time and that lag period, we know we've got a better chance of like a really strong upsurge. But then on the flip side of it, if we can see a lot's coming through from all these different projects of apartments, townhouses, land, builds, all the rest of it, if we know, you know, Stockland's got a 5,000 home block estate that they're releasing over the next 5 years, that's a lot of land coming to the market that home buyers are probably going to gravitate towards that and not have the pressure on the existing housing market. But again, that depends, because if we're talking of even a regional city of 200,000-300,000 or something like that, or even 150 or whatever, it's all relevant to the size. So 5,000 might be nothing compared to the city, or 5,000 could be heaps, could be 10% of the homes in the area. So it's really important to understand what's coming through compared to the housing market that's currently there, and then how is that actually going to affect house prices, be it up or down, or no real effect on it.
Sam, we've just spoken about the macro drivers. There's 4 micro drivers. So we've got affordability and median incomes, which you mentioned at the top of the show, vacancy rates, and then gentrification and the desirability of the area.
Yeah.
So let's start with perhaps affordability and median incomes, because they probably both tie nicely together. So how should we be thinking about those?
It's obviously a massive factor of affordability, okay? So like a lot of people, again, that example I was going back to at the very, very start that we spoke about of people liking to try and chase proven performers. But the affordability of those sorts of areas are shot, because if they're a proven performer, they've already seen a significant amount of growth. How much is actually left in the tank? Now, if there's a big influx of very high income earners, or it might have had a lot of growth, but there's still more left in the tank from an income perspective because it hasn't grown for ages, that's something you really need to understand. But when you look at the average house price to income ratios, like they need to be weighted in the favor of there is still affordability left in the tank for this thing to grow, because every single box could be ticked for everything else. But if a market's maxed, it's maxed. If the local population can't pay anymore, they can't pay anymore. Unless investors were to come in and give it a bump. But even at the same time, there's no owner-occupied demand to back that up. So when they recede, the prices will recede. So it's one of those things where it is probably the biggest factor I overlay on everything that I do. When I look at something, I could, again, tick everything. But if there's no actual room to grow left in the tank, it's not worth putting either mine or my client's money into those locations.
Yeah.
So this, again, might be proprietary data, but you can, if we can sort of get an idea of house prices from CoreLogic and REA, where are you getting like suburb or regional level income data?
That's they're the paid sort of things that you have to pay for to get access to that sort of stuff. So there is like outdated ABS stuff, but again, it's always outdated. And you look at the wages
based on like last census or something, isn't it?
Yeah, and like. It's just not that accurate. And so, man, it's there's a lot of different ways that this is sort of generated and put together. But man, it's effectively the way we get that in, especially in as a real time, as you know, as close as we can get from that perspective. We have to pay for that stuff.
So affordability and median incomes are sort of tied together. The next one is vacancy rates.
Yes. Vacancy rates are they're very, very important. So if an area's got a loose vacancy rate,
does anywhere have a loose vacancy rate at this point?
Yeah.
Right now, no.
Yeah.
But again, that's why we're talking in unprecedented times of where we are right now. In the next couple of years, things will change. And again, like if people were to listen to this in the next couple of years, or they take down all these notes for the way that they assess a market, right? You might build a good portfolio over the next few years, but you've still got to overlay all these things to make sure you're making the right decision. But right now, definitely vacancy rates across the board are pretty tight.
Can you give us like a band in terms of, not right now, but in normal times, what's like tight vacancy, what's normal vacancy, what's loose vacancy?
Vacancies are tight compared to long-term standards, but there's some areas that are sitting at like 1.5% at the moment. Right now, that's considered a little bit of a loose vacancy rate. Anything over 1% is a little bit loose.
That's crazy.
That's now, right?
Yeah.
But like, let's say pre-COVID, right?
Yeah.
Let's go off
Yeah.
pre-COVID sort of levels. 3% is considered a balanced market.
Okay.
I would never buy in a 3% vacancy rate area unless I could see everything else tightening up and I could get a ridiculous deal. 3% vacancy rate is pretty loose. If you can see that the vacancy rate's trending down, maybe it was at 1.5 and then 1, 2 and then 1, and now we're slowly sliding down in the zeros. Something has got pressure on that market to keep it dropping that low.
Now, I'm sure there are proprietary sources of data there, but this one I know CoreLogic track, at least for the major capital cities. So
for vacancy rates?
Vacancy
Oh,
rates,
dude,
yeah.
you can jump on SQM Research, and it's got all your vacancy rates across the whole country for free. So I'll give you that one for free.
Nice. What was that?
SQM Research.
SQM Research. Nice one.
Yeah.
Oh,
I
that's
can't
good.
remember the dude's name that runs it, but there you go. Little shout out for him for his
Nice.
business.
That's good. That's good. Love
Yeah,
that.
man.
And then the final one we've got here is gentrification. And this is one close to Bryce's heart as he now lives in Redfern. and
Yes,
is
let's
part
go.
of the gentrification wave there.
Definitely, man.
Let's
Definitely.
So give Bryce some tips on what he should be doing. I guess, talk to us about gentrification.
Yeah, gentrification's huge. Like, let's go Redfern, for example. 20 years ago, seen as the Bronx of Sydney. It's gone through massive gentrification. So huge amount of housing commission there that was sold off. The old terraces that were there, like I know, like old salty sea dog investors that are like 60 and 70, and they bought them for like $7,000 and then sold like terraces, and then sold them 2 years later for $20,000, and they, amazing result. But like, I didn't want to hold it there. Now they'd be worth like 3-4 million or something, you know what I mean? And this was probably, 70s and 80s sort of time frame. But you look at, if you can buy into an area or understand gentrification that's coming through, it can seriously change a market, especially when we look at like affordability rates and income to house price ratios. The only thing that ever properly warps that is when an area goes through gentrification, because when it gentrifies, all of a sudden people are happy to move in there that previously weren't happy to move in there. They might be higher income earners. Again, we saw this a lot in Brisbane, where those areas I was talking about that were seen as lower socioeconomic, when people out of the mid-ring sort of suburbs got pushed into those, all of a sudden they were buying the old crappy houses and doing them up. And all of a sudden, the demographic completely changed. And the persona of the suburb completely changed. And then all of a sudden, it might not be seen as like super desirable, but it's seen as okay to live in. We've seen so much of this change, and like Redfern's a prime example of it. There's a region that we're buying in pretty actively at the moment. And when we first entered like 2 years ago, there was this one suburb that like, we'd only buy there if like it was a really, really good deal. It wasn't a terrible suburb. It wasn't like the worst in the region, but it wasn't great. But if someone has a really limited budget, they needed a great yield, and we could get it at the right price, we'd obviously make them aware of some associated risks. The really interesting thing to watch over the last 2 years is the amount of owner occupiers, in particular young tradies that were like grew up in the nicer areas, and then they've gone in and bought these and either done them up to rent or done them up to live in. Some of them done them up to flip, and then all of a sudden this suburb is now like seen as not one of the best in the area, but it's no longer like near the bottom. It's definitely like middle of the pack or better, because now there's so many renovated properties coming to market. People who never would have bought there now buying there, living there, and liking it. And so now it's like it's opened that door, and especially obviously that was 2 years ago. It sort of changed over that period. A year ago, we saw the shift that was really happening. And again, it comes to getting on the ground and actually driving around. And this region in particular is our hardest region in the country to be able to do renovations. And when you go up there, you understand why, because almost every house is getting renovated. Like, it's not every house, but like it's a ridiculous percentage of like how many houses are getting traded and renovated, and it's completely changed that suburb. So now that suburb is no longer probably where we would see maybe it going from 0 at the bottom to 100, 120%. Now, because of the different demographic and income earner that's moved into it, now it could do 150, 180, 200. Like, it has to be assessed. Like we always continually assess that. But yeah, that's where it's really changed from that front.
Nice. Well, Sam, thank you so much. That brings us to the end of the factors driving growth. So we had macro and micro there. We'll include the link to the SQM research in the show notes as well, if anyone wants to check out vacancy rates. So a couple of things. If you want to be put in touch with Sam, you can hit us up at equitymates.com/contact, and we can put you in touch. Otherwise, just head to the website, australianpropertyscout.com.au. If you want to chat to Sam about the services that he provides in finding an investment property.
If you want that proprietary data.
If you want that proprietary data.
That's
yes.
If you guys don't mind me throwing in there as well, guys, like on the proprietary data side of things, we just recently launched the new APS course called School of Property. If you want to head there, we're doing like discovery calls and doing strategy sessions if people either got existing portfolio they want to start. Either at www.australianpropertyscout.com.au or www.schoolofproperty.com.au as well. For either people who are trying to do it themselves, School of Property is literally all the stuff I don't talk about and all the little secret sauce and everything, that's all in there. So the course would obviously be for people trying to do it themselves. Obviously, more than happy to have a chat with people from that perspective, or if you want the full service and us to actually, overlay all this stuff where you do all the hard work and then actually get out there and find the properties for you, then Australian Property Scout would be the way to go as well.
Well,
Awesome.
we didn't mention, so we should as we close. You actually won Buyer's Agent of the Year this year.
I did,
so,
mate. Yeah, I did.
Yeah. If that's not a sell, then what else is?
Thank you, mate.
Yes.
Yeah, it was that was cool to finally pick that up.
Yeah,
So
Congratulations.
Congratulations.
thank you, boys.
Yeah.
Appreciate it.
Well, Sammy, thank you for coming on. We'll include some links in the show notes if people want to pick it up with you. But until next time, we appreciate it.
Cheers, boys. Appreciate having me on.
Thank you.